technical situation, we've not signaled the major breakage yet. We still think downside breakage is likely to occur. This rally looks like it could be exhaustive, newsy, and that's not the kind of thing you want in an old bull trend that's already showing signs of exhaustion, that's already by various metrics, including fundamental type, that these new highs aren't confirming. There's too many things that are wrong, and our metrics, that's what we see. So we do not trust the rally. Now, we're measuring, especially the NASDAQ 100, because it's been the leadership index for the last 15 years. It's gained more than twice as much as the S&P. And it's, front-end loaded with the name stocks, NVIDIA, Amazon, Apple, et cetera, et cetera. As it goes, the market will go to varying extents. It's been up more than others. When it goes down, it'll go down more than others. When we measure it, we measure on a shorter-term level, like weekly momentum. How is price doing versus its 3-week average? We create an oscillator, and it often looks different from price. We run it versus its 3-month average, 3-quarter average, et cetera. And we're looking at different time scales of its trend. I've never seen before the configuration of breakage levels on momentum that are so tightly clustered together. Normally in an inhale-exhale market, as you're moving up or down, you can break something short-term and create some kind of counter-trend move, and it doesn't alter the big trend. But right now, we have a situation where we've already damaged weekly, but the monthly momentum, literally just below the lows we saw last week, will blow major support structure. And about 1% or 2% below there, I'm going to blow major quarterly momentum structure. So when we look at it from our vantage, not just the simple price chart, which everybody looks at, we don't see glory on the upside. We see lower and lower highs. In other words, the NASDAQ made a high back in July in price. It took it all these months up until yesterday to finally take out that high. So with 5 more months of labor just to get back and nip it out. Momentum isn't making a new high at all. It's a much lower high. And this is going on with many sectors, many indices. So I think we're making a top. I do not trust this rally. I think it looks exhaustive, and therefore I would be highly spooked if I were a bull. If we drop back, and I'll just say this, you don't want to see the NASDAQ 100 back down around 2,000 again. It got up to 2180 today, okay? The July high was, I think, 20,675, so we took it out by like 0.5%. You don't want to go back down and visit the price lows we just saw a week ago. If you do, I think it's over. So that's our opinion of the stock market. And obviously, we've always argued that, especially in this environment, with the asset class movements and money flow from one to another, that when this market breaks, biggest bubble in U.S. history, it's going to have wave effects in other markets, and it's especially going to upset the central banks. So I don't just mean the Fed, but Europe, Japan, so forth. They're all tied together, okay? And they're all don't want their markets to break down. We're the one in particular that should be watched because we're the biggest bubble. When that happens, I think you'll see a brief flush of money out of the stock market into the T-bond market, which, since the Fed rate cut back in September has gone the opposite direction of the stock market, where yields have risen, bonds have dropped in price. Stock market's gone up. Now, the stock market, I think, is trying to peter out, and the bond market is trying to carve out a low. And if you see it start to move up like about a point above where you're trading right now on the T-bond futures, it's saying, well, I'm coming up out of the hole. Well, why would that occur? Possibly because money is starting to move out, doubting money, early money is starting to move out of the stock market into what is perceived to be a possibly safer place. And I think the monetary metals will be a large beneficiary of a downturn, a major downturn in the U.S. stock market. Trump is an expression, I think, of not only emotion against what's been going on, but intellectual policy shift. Let's put it this way. He's not an intellectual, but he's sort of got an idea of what's wrong. But he's got many ideas that possibly, you can argue, don't fit with a real free market perspective. And as you said, in his administration, the debt rose and so forth, and he wanted the Fed to cut rates to zero, et cetera, et cetera. There are many people, though, in his administration that are emerging, we know, that are got their heads screwed on pretty good. So there's going to be a lot of good policy, let's give it that. But it's going to be mixed. I mean, tariffs is, I'm glad they're going to cut my income tax. And frankly, if you break the stock market, don't count on having to pay taxes next year. Because if the IRS can't collect taxes, because of dysfunctionality, too many people can't file, don't file, have to file for delay because they're hurting. Too bad. You take 20% off their IRAs and so forth. The pain's going to hit them from the other side. It was hitting them on the consumer side. Now all of a sudden their sense of safety diminishes. It wouldn't shock me that he has to revert to sales tax or definitely the tariffs. But again, even if you think he's a hero and his policies are headed in the right direction, you've got to realize that there's been decade after decade. I don't just mean 4 years of Biden, okay? Biden didn't do anything to cause inflation. Government spending, but they all do that decade after decade. The president's Congress does. It's the Fed that really did that. They're the ones that pump money into the system, gave us free money for 10 of the last 15 years. Fed funds rate effectively zero. But that process of rising institutional control over our lives, economic controls, regulatory controls, even if you move to dismantle that and to lessen taxes, for example, which is, let's say, a good direction, okay, you've still got a monster that's going to break because you've got errors that have been compounded over not just the past 15 years of stock market bubble, but decades of built-in systematic errors and pain that's been hidden that will be unleashed when the errors are exposed. So it's not like you can go in and simply stop that. That's probably going to have to pay dues, all those compounded errors of decades, and especially the last 15 years where money was free. That creates massive mistakes on the parts of individuals, families, corporations, etc. And when those dues have to be paid and we expose it, I think the stock market is like the big needle. When you punch a hole in it, all these other errors will be exposed. All the data points you want to look at that look, okay, they'll suddenly won't look okay. They'll go dark quickly. That's been the history of data points anyway. So even if he's on a correct path and people behind him in Congress and so forth and in his administration might be moving in a correct direction, they got a monster that's going to collapse on them. And unfortunately for them, they'll probably be blamed for it. If the stock market gets down real hard during his administration, they'll say, well, Trump did it. No, it's the history, the buildup of these errors that finally has to unleash. And so the assumption by Trumpers who may have bought the market, the last few days aggressively, while it's a lovely thought and maybe we're headed in the right trajectory, there's too many big bad things that are likely to have to come first, not joy. And therefore they've made a mistake. And we shall see, but our technicals argue, do not trust this. If it sneezes, it's going to cough and it's going to go down hard. We've had, after the 3 years of lethargic action by gold, where it was caught in a 20% range, that's all, 20%, max high to max low. In fact, most of it was a 15% range between mid-2020 and early 2024. Silver and the miners staircase down gradually while gold went sideways. But once we emerged in March, the tone of the market changed, and of course, gold shot up nicely. Silver went from our breakout level was between 25 and 26 on momentum, and we shot up to 35. But in that process, you'll notice they continue to have these repeated sell-offs. Sometimes they last several months, April to May, June, July. In gold, for example, where it went sideways, silver corrected down, or several weeks, or recently just a very bad week. Now, there's a point at which this bull market will prove to the doubters, who apparently are constant out there. In fact, I've never seen such doubt as we've just had with the recent drop. I think everybody who's been a doubter has jumped on board. That was it. It's all over. One of the assumptions there is that the stock market goes down, gold and silver go down. Well, the stock market just went up big, gold, silver went down. Okay, fit that into your logic, okay, if you believe that. So, our argument is if the stock market goes down, it will further fuel the central banks into what they do best, which will ultimately quickly refuel gold. Not that it needs refueling because it's ahead of events. It knows what's coming. So I think a downturn in the stock market will not hurt gold and silver. It will help them. Just the opposite of what's happened in the last 72 hours. So the recent drop did not break anything on even intermediate momentum, long-term, nothing was broken or even jeopardized. Whereas everybody screamed, that's it. I don't know what they're going to say when we go back to 2,800 gold and silver goes back up to the mid-30s again, 35 or so. When are they going to shut up? I think there's a point at which the gold and silver move will advance so aggressively that it will take breath away. Meaning, if you go back to 35 and gold goes back to 2,800 and people say, well, golly gee, we were wrong again. It's not the top. There'll be a point at which you won't just go up another couple $100 in gold or another $2, $3 in silver and then have another of these processes. That's our view. Well, I don't know that you need a cat. I think it'll be technical only. In other words, and then you find the explanations late. Usually that's the way it is. It's usually rarely a dark cloud comes over and says, instead the market breaks sharply and people say, what happened? And then all of a sudden the data points start to change. The underlying data points that are already not really good anyway, but the Fed likes to say how good the economy is. So the stock market is the leader. Watch it right now, because when it goes, that will provide one further impetus for gold. And temporarily, and I say temporarily because I'm not a friend of long-term U.S. government debt. There's a lot of major analysts, including one from Bank of America a couple weeks ago, said, do not buy U.S. Treasury bonds. Okay, this is a chorus from very wise people. Many analysts that I respected aren't technicians. But the technical situation in bonds looks like you could actually get a spike on the upside for a couple months maybe, where if money moves out of the stock market in a somewhat surprise process, not really, but to many people, money will flow into T-bonds for a while. The main beneficiary ongoing will be gold and silver. But generally speaking, you don't want to go back down to where we were a week or two ago in price. That's only several percent below you. So if you do that, something's wrong, and it likely will be exposed fairly quickly. And I don't mean a crash, but I mean you could have a 10 or 15% jolt very quickly. I'm not looking for a crash up front. It's always possible, but I suspect not. I suspect it's in double-digit jolts. And during that process, I think gold and silver will be perceived, and many analysts do now. They realize, it's beating the stock market. In fact, it's been beating the stock market for a couple of years. If you go back and look at the spread low between gold versus the S&P a couple of years ago, gold has appreciated quite rapidly from that low in a significant percent. And year to date, gold's up like 30 some odd percent. Okay, and the S&P is up like 18 or 19. And silver, by the way, is up more than gold. At least it was a few weeks ago, year to date. So asset managers are noticing that. And so when that stock market wobbles, it's going to spook movement of money. They got a big goose the other day. Bank sector went up very large on the Trump rally. The banks will go with the market, and whether they lead it on the downside, I suspect not. But all the sectors of the market will go down with the market. Watch NASDAQ 100. The S&P is closely, by the way, our trigger levels from NASDAQ that tell us, okay, we've really started. Again, I've roughly defined it as don't go down to the lows we saw a week and a half ago. S&P has numbers down there too. So S&P doesn't have to go a lot further to trigger its stuff. So when it goes, all the sectors will go too. And no doubt there will probably be, in the banking sector, a symbol here or there that will get a headline. And of course, all it takes is like one. I don't mean some tiny little bank, but some regional or medium-sized bank that has a headline and people say, oh my gosh. So, but the real bubble is in, of course, the tech arena. And I'm not saying that the tech arena is unjustified in the bullish outlook of how it's going to change our lives, no more than .com did. .com bubble broke and dropped 82%, NASDAQ 100. And so I can't argue that AI is invalid. It's just that it's overpriced. So even if it's as valid as people say, it's still a bubble. And also there's some other indices overseas that very much resemble ours. Not Europe. Europe is not a bubble. China is certainly not a bubble. They're not even double the price they were in 2009. But Nikkei in Japan, again, monetary policy helped create that one. And the Sensex in India both look like bubble-type markets that are very much in sync with us in terms of how much do they have to drop to blow their structures. And I'm not talking price, but momentum structures. They're pretty much in sync. So this U.S. drop would not be isolated. Hence, the central banks of the world will go berserk.